Hi, a very good morning to everyone. My name is Ting, and I'm the management accountant for Maxalki Sdn Berhad. So recently, Roger, who is a senior engineer that has 15 years of working experience that are specialized in manufacturing electronic device, has been planning to start a new business and launch a new electronic device called Model K in 2023. By using the information that Roger has provided, it shows that the net profit is constant without any net loss with a total net profit of RM 184,469 in quarterly income and expenditure budget. There is cash flow deficit at the closing balance in quarter 1 of 2023 till the opening of quarter 2 of 2023. After quarter 2, the closing balance is surplus and it shows that there is a surplus in cash flow with a closing balance of RM 184,468 and 36 cents in quarter 1 of 2024. Roger has extra of RM 600,000 of cash in hand on top of investment of Model K. There is two investments that he would like to choose from, which is Project B and Project C. For Project B, there is a cash flow deficit in quarter 1 and 3 of year 2023. At quarter 1 of year 2024, it received the highest amount of net cash flow of RM 2 million. For Project C, the net cash flow is the highest in quarter 2 of year 2023 with the amount of RM 354,000. Quarter 1 of year 2024 has the least net cash flow of RM 25,000. The NPV for Project B by using the net present value at 25% is negative RM 198,600. The NPV for Project C is negative RM 121,198. The NPV for Project B by using the net present value at 10% is RM 305,995. The NPV for Project C is RM 43,552. The internal rate of return for Project B is 19.1% and the internal rate of return for Project C is 13.97%. Higher IRR means higher return. So in conclusion, Roger should invest in Project B as it has higher internal rate of return compared to Project C. So the two financing methods are internal financing and debt financing. The strength of internal financing is it helps Rogers to make decisions and act promptly as it can open up prospects for deals in investment or big transaction. Besides that, it has low cost of capital as interest charges for loan and credit cards are eliminated. Furthermore, a collateral is not needed since the company is using their own resources. The weaknesses of internal financing is the ability to grow is constrained if Roger relies on internal financing to fund his operation. Besides that, there is no external expertise or network which can add knowledge that can benefit the firm. Other than that, the daily operation is affected as company will reduce the budget of other departments within the company to fund long-run projects. The second method is debt financing. The strength of debt financing is it lets the company to maintain control while still getting immediate funds. Besides that, it gets tax reduction as debt financing is seen as a business expense. Furthermore, it helps to improve business credit as it shows the company's dependability. The weaknesses of debt financing is loan repayment as company is expected to pay the principals and interest. Besides that is collateral as creditors will want company to offer collaterals. The factors to be considered in developing and managing budget is the size of available fund. Roger needs to be aware of his organization financial status before developing a budget. Besides that is to have a long-term business goal as budget must be aligned with corporate objective. Furthermore, industry and competitors analysis is industry and competitor analysis as industry trends may have an impact on business operation. Other than that is project return on investment as capital should be invested in opportunities where there is higher profitability, higher probability of profit. Besides that is revenue estimation as employee will feel compelled to complete certain tasks before the deadline. Other than that, is cost and expense incurred, as the goal is to maintain effective margin between revenue and expenses in order to generate sizable profit. Furthermore is identifications of capital expenditure, as it is important to know which need more capital. The benefit of budgetary control is it formalizes business objective by setting different type of budget, and different department will prepare different set of budget. Besides that is outlining the goal for different level of management. Budgeting bridge the gap in communication between management and employee. Furthermore, it can evaluate the performance of employee, as the top management will make corrective actions when there is a difference between the actual performance and expectation. Other than that, is it provide clear-cut goal and target, as the goal set in advance as the goal is set in advance for different departments. Other than that, is it increase efficiency in operation, as expenses are carefully budgeted. The limitation of budgetary control is it will have coordination problem if it is not managed properly. Besides that, is it create conflict between functional department, as head of department only attentive towards their own department without taking into account on organization goal. Furthermore, budgetary revision is required, as budget is created based on expectation that circumstances will occur. Other than that, it provides uncertain future because forecasts might not turn out to be correct. Besides that, it discourages efficient employees, as the employee will feel satisfied by reaching the goal even though they can go above the target. In conclusion, Roger should start a new business and launch Model K, as the project will be earning profit, and Roger should be invest the extra RM600,000 in Project B, as it has a higher rate of return compared to Project C. So that's all from me. Thank you.